The United States, the world's largest economy, is facing growing concerns about a potential recession, sending shockwaves through global and domestic markets. Recent economic data, including a weaker than expected jobs report in July, has raised fears that the Federal Reserve's aggressive interest rate hikes may be slowing economic growth. The impact of these fears extends beyond U.S. borders as economies of the world are closely monitoring while investors grapple with uncertainties. But what does this mean for Nigerian market? I'm being joined by financial investment advisor, Mr. Gbenga Ogunrinola from the United Kingdom to continue this conversation. Thank you so much. It's really good to see you this afternoon.
Thank you, Tolu. It's nice to be here again today.
Well, I think we should start with the panic sales by many investors that we saw on Tuesday. Key markets in Asia and Europe, and Asia raised red flags. That's what I think we should call it. Should this be as a result of the move by the Fed, or what do you think is responsible for this?
I think there's a number of things responsible for this. It all started on Friday last week when the non-farm payroll reports came to the market, and the report was below expectation, far below expectation. The projection and forecast was that we would see about 178,000 jobs added in the US, but rather than 178, it was 114,000, which was a far lower figure than was expected. Now, before then, there had been one or two other issues that investors and analysts had been monitoring. One of them was the Fed meeting, where the last Fed meeting that was also last week, and it was expected that the Fed was going to reduce interest rates, but that wasn't, that did not happen. And based on that, people believe that the Fed is probably acting too slowly in trying to adjust to events in the economy. Prior to that also, there had been the issue of the belief that the major tech stocks are probably overpriced, and that there might be an effect whereby those prices begin to realign to what the market believes should be the fair value, which could be of a major effect globally, because generally we have about 20 of those tech stocks being about 18 to 20% of the world global market capitalization. I mean, talking about stock market now. So the fact that one or two of those stocks is having a bad day could actually affect the global market. So all that, coming together with the non-farm results kind of sent shockwaves around the world globally. In fact, I remember that particular day when the result came out, there was a lot of plummeting of major markets in the world, and it's continued up till Tuesday. But I believe that with more reports coming up this week, those fears are being gradually assuaged, and people are believing that probably it was just a panic movement.
Indeed, we saw the loss recorded by some notable stocks on that very day. Yes. The big boys, the big bucks, the guys with the greenback. Well, let's look at U.S. elections as it approaches, and huge campaign spending and all of this. What do you still think about the economy itself? Any fears of the recession indeed, in reality, in your thoughts?
Well, the last report that came out regarding the GDP, generally we believe that when we talk about recession, we're looking at a steady decline in GDP of the economy, and that is not the case currently in the US. The last report that came out for the second quarter showed that there was a 2.8% increase, annualized increase in the economy. So if we look at that critically, it does give some level of comfort that there's really no fear for recession now. But the way things are globally, especially the way the market is structured now, the market remains very fragile. because there is a number of, like I said earlier, the tech stocks are about 18 to 20%. That's the major 20 tech stock form about 18 to 20% of the global world stock market capitalization, which is not so good. So if anything happens in that industry, there could be a trigger, globally. Also, we have a number of digital currencies in the markets today, and we have investors also heavily invested in those areas. So anything coming up from those areas too could shockwave to the global markets. So the market itself is very fragile, and I think that we just need to be cautious in whatever we do.
But the implication for African markets now at this time, this general wave of fear of recession, of course. But what do you think, or what should African markets do in case anything happens on the global side? What impact will it have, and what can we do to withstand the heat?
Well, the African market is not immune from, if there's a global recession, we are part of the global community, so we won't be immune. But I believe that one of the things that we are seeing in most African economy now is local involvement in the markets. We are seeing a lot of local investors coming into the market deeply, and also trying to participate, in the markets. I believe that should be encouraged more, because if we have more locals in the market, even if there's a shockwave globally, it will reduce the effects. I mean, it's not going to eliminate the effects, but it will reduce it. As long as your market is open to the global world, there's no way that there won't be any ripple effects, because what we would see at the end of the day is people trying to dump their investments and go to safe havens, currencies like the US dollars and Japanese yen and some other currencies, like the Swiss francs. So those are some of the effects that we'll see. But I believe that the more we have local investors in the market, the lower the cumulative effects that we'll see in the African continent.
Let's look at the economy of the UK now specifically. There's been issues also around investments and boosting growth. What do you make of that economy, and what are your prospects for it?
Well, the UK economy has not really had a good share of the general global growth in the last couple of years. And I believe that now the economy is a bit more resilient and trying to catch up with the rest of the world. So where you have other economies, especially when there was this shockwave of recession, being hardly hit, especially in Asian and even some European economies were hardly hit by this fear. The UK market has been a bit very resilient compared with others, because it's not really had a good run over the years, especially in the last few years. So it's playing a catch up, and I believe that we will still see more of that, going forward in the markets. And I see it as more resilient now than ever before. And even though we have a little bit of issues currently, but that in itself is something that I believe will pass by very soon, and the UK economy would continue its run. It's been having a good run this year, and I believe that it will continue till the end of the year, and probably up till the next 1 or 2 years.
So like everyone will say that money only goes to places where it feels safe. Money doesn't stay where there is no safety or where there's no security. I know you would agree with me. Now, what factors do you think investors, or what factors should investors consider before making decisions moving forward in 2024? Considering global, even in Nigeria, we're trying to put up policies that would, of course, attract more investments even to our markets. What do you think investors should consider at this time? What factors?
Yes, so investors should be more careful about where they are putting their investments, they should look at the figures properly. Most of these areas that probably are considered as safe havens, probably the growth there has gone up so high, and entering those markets now could be a bit late. What I mean is that probably you're entering at a very late period where you might not get the kind of investments and returns that you wish to get, compared with entering some other areas where it is still more like a virgin area, and there's still more prospects of growth in those areas. So I think investors should be more cautious in the area of where they put their money. Yes, you want to put your money in areas where it is safe, but at the same time, look at the returns, look at the projections, look at what has been the run over the period of about five years. If it's been consistently going up over 5 years, then you should be a bit cautious about the fact that will it continue to go up? Is it overpriced, or is the market still very fairly priced? So all those are very important. Like I think about 2 weeks ago, there was a particular tech stock in the US that also sent shockwave because people felt that they had been overpriced. The issue of artificial intelligence too, that people had also, investors had also probably positioned themselves that stocks in those areas are going to do very well and probably get shown good results. They are saying that that is not the case currently. So all that is things to be noted before you put your investment in any market now, because there's so much fragility in the market, and a lot of assets have gone up over the years, and it might not continue to go up the way it's been going.
Oh, let me bring you back to Nigeria, though you are not in Nigeria, speaking from the United Kingdom, but let's come back home and look at the recapitalization process that is expected to happen very shortly. What do you also make of the stocks from the banks? They are offering shares and all of that to investors to come in. How do you think that will reshape the performance of the market moving in the year as they're moving forward?
Yes, I believe it's going to deepen the market, even though there's paucity of funds in the economy too, which is great. But I believe that if we dollarize our markets and want to be competitive, then we need to also up our game to be more competitive. We discovered that even if foreign investors want to come into the Nigerian markets, I mean, what are the assets that they are able to invest in Nigeria? So, but apart from maybe just capitalizing, I think we need to also look at the various assets that we offer to the investing public generally in Nigeria. We need to deepen the market. We need to increase the number of assets that are available for investors to put their funds in. And when we do that, then we'll see more foreign investors coming into our markets and the African market generally. I believe that the foreign markets, the developed markets, are kind of saturated, and some of these investors are looking for areas where they could put their funds, of course, safe areas where they could put their funds with good projections that they'll get good returns on investments. But if the assets that are available are limited, and the funds are, I mean, so you have so much funds looking for just few stocks, they wouldn't come because they believe that the market is not deep enough. So the capitalization thing that we're going through in Nigeria currently, it's a good omen, but I think we need to also look at the assets that we offer to the investing public and to attract foreign investors into the markets.
Thank you so much, Mr. Gbenga Ogurinola, Investment and Financial Advisor, live from the United Kingdom. We appreciate your time and enjoy your weekend.
Thank you, Tolu. It's nice to be here always.